Home prices in Vancouver have just dropped for the seventh consecutive month in a row. The November stats are out, and we are sharing what is most important with you today. What's more, we are dissecting Ottawa's new budget, which promised housing help, but honestly, most dollars are just chasing rentals, not home ownership. And the deficit path could nudge rates higher for longer. Meanwhile, jobs surprise to the upside, arrears are still incredibly low, and GDP is sputtering, and there is a wave of Indigenous land claims that are injecting fresh uncertainty into land titles across all of BC. In this episode, we're unpacking the budget's real impact on housing, where prices are headed into the winter, and the title risks most people are actually missing. So today we are starting off with the federal budget, and it was obviously released this week. And as we are a housing podcast and a housing channel, we're going to focus primarily on what was promised versus what was delivered. So the Build Canada Homes program receives barely half of what was promised in the Liberal platform. Instead of $11.8 billion by 28 and 29, the budget funds only $6.2 billion. So that's a promise that was basically cut in half. A recommitment, or what was previously existed ultimately, to the previously announced first-time home buyers GST rebates for homes up to $1 million, and a reduction in GST for homes between that 1 million and 1.5 million price point, well, that stays. That still exists, so that was not changed. Now, development charge relief has been diluted. The platform had committed 1.5 billion annual to development charge reduction. That has been reduced to 1.2 billion. And the requirement that development charges be halved has been replaced with one that merely requires them to be substantially reduced. So a bit ambiguous there. The MURB incentive is essentially missing in action. Despite the platform's commitment to reintroduce the multi-unit residential building tax incentive, the budget is all but silent on that measure. The focus shifts from housing supply to reducing housing demand through scaling back immigration. So this is a pretty important one. In a basically striking departure from past rhetoric, the budget frames housing affordability improvements as stemming from lower immigration targets and reduced population growth, essentially asserting that Ottawa is taking back control of immigration to bring immigration back to sustainable levels. Basically quoting that they had lost control of immigration, which, let's be honest, is basically the case. Now, there was the elimination of two other programs, the underused housing tax and the unimplemented Canadian Mortgage and Housing Corporation, the CMHC, Canada Secondary Suite Loan Program. Ultimately, the loan program wasn't working, it wasn't being adopted, so why continue on? But the underused housing tax being eliminated is helpful, in my opinion. Now, there were changes to the National Housing Act to raise CMHC's guaranteed limits to $1 trillion and ultimately decouple it from the insurance limits to support homeownership and the multi-unit rental construction. What's more is there's a $51 billion Build Communities Strong Fund. That is going to be split into three streams of funding, including $17 billion of provincial and territorial stream over 10 years to support housing-enabled infrastructure. So they have this fund now to help build roads, water, wastewater infrastructure. There's also a health-related infrastructure stream, which is ideally or ultimately bringing in more hospitals and infrastructure at colleges and universities. So combined with other programs, this can be used to ultimately encourage lower development charges and levies on new housing development. That's a plus. There is a focus on building new housing for Canadians through the BCH, or the Build Canada Housing, including $1 billion for transitional and supportive housing for those experiencing homelessness, and a $2.8 billion recommitment to the urban, rural, northern, and Indigenous housing strategy. However, the budget offered limited concrete measures to support Canadians currently aspiring to achieve affordable homes and home ownership. And support for more onboarding of missing middle is also absent, risking slamming the door for, again, further home ownership for many. So essentially what the budget said is it's a huge focus on affordable rentals and ultimately nothing to help create affordability for those looking to own a home. So if you voted Liberal based on their housing promises, it kind of feels like that rug has already been pulled from underneath you, right? What they promised and what they delivered only a few short months ago, it's gone from promise to reality, will be a nice way of saying it. Now, there were also new insights from Abacus data, and it found that among younger Canadians, aspirations to home ownerships, well, it remains really high. Like something like 86% of non-homeowners, the younger generation, aged 18 to 29, say they would still like to buy a home someday. But again, the data shows something a little different, right? Because from 2011 to 2021, the home ownership rate for 30 to 34-year-olds, it dropped from 59.2% down to 52.3%. While young aspiring homeowners have reasonable expectations, traditional missing middle housing, such as semi-detached and townhomes, make up only slightly more than 11% of all of Canada's housing options, leaving young families and seniors stuck between housing options that are either too expensive or simply too small, ultimately unwanted or unattainable. This Liberal government has committed to running the largest deficit in history during the next 5 years. Now, we're going to display a graph that shows exactly what this looks like. But what's more, this is their projection. And the question kind of now shifts to, should this budget actually end up being adopted, will they even hit those targets? Or in like a year from now, are we going to hear that, oops, they overshot and here we are at 100 billion or whatever that number is going to be? Running at a record deficit for the next 5 years, to me, it's kind of akin to hiring a new CEO of a Fortune 500 company whose platform is to guarantee that company will lose a record amount of money for the next 5 years. Is that who you want running a company for you? How is that sustainable? Like, when does Canada's federal debt actually become dangerous is kind of the next question I have. And what's the number that forces dramatic action? So I just want to break this down quickly. So right now, Ottawa pays about $55 billion a year just in interest. That works out to roughly 10% of every revenue dollar that the federal government collects. Historically, it's actually considered manageable. For context, the last time Canada hit a true fiscal wall was in the 1990s. Back then, over 33% of all federal revenues were going towards interest, a third. That's when rating agencies stepped in, cuts were made, and the entire budget structure had to be rebuilt. So what could possibly trigger something like that again? Well, there's no singular magic number, but we have some reliable guardrails. Mild stress shows up when interest hits around 20% of revenues, roughly 100 billion in interest at today's revenue levels. Severe stress is around 25%, let's call it 130 billion. And a true crisis, aka the 1990 zone, well, that happens around 35% or about 180 billion in annual interest. Now, these aren't theoretical, okay? They're based on how markets, rating agencies, and governments have historically reacted. How could we get there? Well, persistently higher interest rates, running deficits year after year, and slower economic growth, which reduces tax revenues while the debt keeps on growing. So if Canada approached those higher burden levels, the playbook is kind of predictable. There'll be spending cuts, slower transfer growth, targeted tax increases, potential asset sales, and pressure on the Canadian dollar as market reprices risk. Mortgage rates could also feel upward pressure because government borrowing affects bond yields. So the key takeaway for homeowners is this. Anyone watching the market, Canada is ultimately nowhere near the 1990 style crisis, at least not today. But we are on a trajectory where interest costs are rising faster than expected, and the gap between stability and stress can close quickly if growth slows or if rates stay elevated. This is why tracking debt service and not just the size of the deficit is crucial. It's the canary in the coal mine. Ryan, what are your thoughts on this lovely budget?
Look, it's very clear to me that Canada needs to spend some time and money reinvesting into our own country. The thing is getting us over this hump in any kind of reasonable time frame is just not realistic. What we need in terms of infrastructure, what we need in terms of resource management, partnerships, people to buy the resources that are not just the US, is going to take a decade to come together. So this is not something that's, I think, going to be solved in just one budget. And the other thing that kind of gets to me is, there's never really any kind of talk in this budget about tackling Canada's national debt too. And many people don't know, but Canada is just about $1.3 trillion in federal debt, which is about $30,500 per Canadian that we have in terms of debt that we all share. The growth of that debt per day is about 110 million, or about $4.5 million an hour. So for me, I can appreciate the fact that money has to go back in so that we can reinvest and we can keep the engine going. But at what point are we going to actually start tackling the national debt? Because it just keeps growing and growing and growing. And when you're talking about a budget here that is the biggest of all time, it's certainly not going to help towards the overall debt, whether that be investment or cost. It's just going to add to that debt. So for me, I think the result of this is not initially, but in the medium to long run, the inflationary pressures that'll come as a result of this. You cannot spend this kind of money into an economy. Again, whether it's investment or whether it's a servicing cost, it's still money spent. That amount of money going into this economy is going to create inflationary pressures. Now, that might change housing prices, but it will crush affordability too. It just won't be in the near term. It'll be in the medium to long term. And that is such the political environment that we find ourselves in today, where we just have politicians that are really focusing on how to get reelected, 2 to 4 year plan, if you will. And nobody really trying to figure out how we're going to tackle this long-term issue, which is our just kicking the can down to the next generation. And it's I don't think it's very fair or responsible. Maybe it's the lesser of two evils that we have to deal with right now. Let's move over here to employment. And here's a twist that nobody saw coming. Canada's job market just posted a major surprise to the upside. In October, the Canadian economy actually added 67,000 jobs, lifting total employment to over 21 million people. That pushed the unemployment rate down to 6.9%, defying expectations of job losses and marking the second consecutive month of growth after a weak summer. Now, to put that into perspective, economists were actually calling for a drop of 20,000 jobs and an unemployment to increase to 7.2%. But instead, the opposite appears to have happened. The private sector led the rebound, the first meaningful increase in private sector employment since June, signaling a modest return of confidence in hiring. That's great news. Average hourly wages climbed 3.5% year over year to just over $37 an hour, showing that while the labor market isn't booming, it's holding up, potentially surprisingly, well under the pressure of high rates and higher rates and slowing economy. But and this is key, the quality of those gains, it matters. What kinds of jobs are we talking about? The October increase came entirely from part-time positions, with 85,000 part-time jobs added, and the meaningful 18,000 full-time jobs have been lost. So I don't know really how, it's funny how we read these headlines and we read these stories as if that, gaining all of these jobs is a good thing. But in my opinion, how many of those people are getting a second job to offset the cost of affordability in their life, and it's being reported as a positive when really we've lost 18,000 of the full-time, economy driving jobs, right? So that for me, it's when you look under the hood, you definitely find something different than what's being presented to you. Most of the action was in Ontario too, particularly in retail, transportation, and information and recreation, IT. Meanwhile, construction employment fell by 15,000, adding another layer to the housing supply slowdown that we've been tracking across the country. Here in BC, the story is diverging a little bit. The province lost nearly 3,000 jobs in October, with Metro Vancouver down 0.3% month over month. The unemployment rate in BC rose to 6.6%, and Vancouver's ticked up as well to 6.3%. That softness reflects the slowdown in the construction and development activity that we've been seeing, especially in the pre-sale and new build markets. So what does this mean for the Bank of Canada and by extension, the housing market? Well, most economists now believe this report cements the BOC's decision to hold rates steady at their December meeting. Desjardins and CIBC both came out saying the same thing, that that with inflation easing, the job market showing just enough resilience, it's unlikely that the bank will cut again, at least this year. The bottom line, this jobs report is good news, but it's not great news. It shows stability, perhaps, not strength. The economy isn't collapsing, but it certainly isn't booming. And for housing, the signal of continued cautious stability, perhaps. Rates are likely on hold. Affordability will remain where it is, which is tight. And construction jobs will stay under pressure throughout the entire winter. It's a reminder that even the small surprises in employment can shift the rate outlook. And in this market, every basis point counts towards affordability.
Okay, we want to now touch on the Indigenous land claims that are all over the headline news. It'd be impossible to not have heard at least some information regarding what's happening here. We want to share some of our thoughts. So ultimately, like when a land title cloud touches down, further confidence will wobble, right? We're already in a low confidence landscape, and these claims are just basically throwing a giant wrench into the machine even further. And it's exactly what we're kind of seeing and experiencing after the BC Supreme Court recognized the Aboriginal title for the Cowichan on that, of course, swath of southeast Richmond that includes public lands and roughly about 150 privately owned parcels or homes. So we're sharing a screenshot right now of the ruling where the judge in the BC Cowichan Tribes case struck down the government's authority to override native title. And then she struck down the sections of law that make your land title supreme or indefeasible. And then she made it precedent. So it reads in part, a precedent that will follow from this case is that the provincial crown grants of fee simple interest do not extinguish nor permanently displace Aboriginal title, as Section 23 and 25 of the Land Titles Act do not apply to Aboriginal title. I mean, to me, this reads that ultimately two titles cannot exist on one parcel of land. The judge has paused the practical effort for about the next 18 months, and every level of government has now moved into the appeal phase. But the headlines alone have spiked, understandably, anxiety for homeowners, for lenders, and buyers that are trying to price in or understand if they should even buy or if the risk is just way too high. So two things matter for today's market. First, the decision says Aboriginal title and fee simple can coexist, which again, to me, reads the opposite. And again, if you try to take a two title property to a bank, they're going to probably just laugh you out of the room. It's an idea that makes obviously lawyers and average mortgage holders, well, sweat. It seems as of right now, the banks are a bit on the sidelines. They're not making official claims as to which way they're going to head or decide on when it comes to lending. And they may very simply wait until the Supreme Court of Canada's decision. As mentioned, there's going to be no bank right now that is going to look at, let's say, the Cowichan lands in Richmond and say, oh yeah, if you want to buy on that, we're happy to lend, because it's too ambiguous. It's too unknown. And that puts things like refinancing and, of course, business lending and investment into such an area entirely into ultimately a chaotic state, let alone the wider ramifications of investing in BC. Take, for example, a company looking to build a data center in Richmond on land that could technically be under question as to who the rightful owner is. Well, they wouldn't, right? They wouldn't invest in such an area with such high risk. So until the appeals are heard, expect longer due diligence periods, more frequent use of lawyers' opinions, and tougher questions from lenders and insurers affecting these lands. Ultimately, I feel like a lot of these people are kind of throwing their hands in the air and saying, we can't do anything until we have certainty with the president. So second, perception is reality, right? Even with legal exposure, or when legal exposure, is limited or stayed, uncertainty widens these bid-ask spreads. I mean, who's even offering on these properties right now? I can't imagine anyone. It's a very challenging time for anyone who owns in that area in Richmond. If you were hoping to sell today or any time, ultimately over the next 2 years, maybe, they're kind of trapped in their houses at this point. So we are understandably already in a slow market, and this throws again that proverbial wrench into the machine. It's going to just grind everything into more chaos. But here's the thing: when we zoom out, Richmond isn't an isolated story. In the BC interior, the Secwepemc, and I'm sure I'm butchering that, my apologies. They've recently launched a civil claim dating back to 2015, asserting Aboriginal title over vast territories that includes the entire city of Kamloops and the Sun Peaks Resort. While the case has moved slowly, as most do, it's a reminder that claims often encompass crown corridors, including roads and railways, municipal lands, and yes, areas with private titles layered on top. And it isn't just BC. We just recently heard that in Quebec, a fresh filing this fall from the Algonquin communities asserting Aboriginal title over about 38,000 square kilometers in Western Quebec. A claim that, like BC, well, it'll run through the Superior Court and the appellate systems over years, right? These don't take months. They are years in the making. Different legal histories, similar market psychology. Whenever a new claim is filed, local confidence dips, process friction rises second, and pricing adopts last. It's as if the precedent set by the BC Supreme Court has opened the proverbial floodgates to a litany of future claims. I would expect that we are going to hear about potentially dozens of more land claims before the Cowichan appeal decision is even made. Most BC homeowners, I think, have no idea, right? Your fee simple property is almost certainly overlapped by one of the 200 plus unresolved Aboriginal title claims that exist today. Courts are now declaring Aboriginal title over private lands. And we are now going to post a map provided by the government of the areas currently under claims by First Nations. If you would like a link to this BC treaty map to see if your property falls under one of these claims, just type map into the comments and we'll send you that link and you can go zoom in on your property and see where it stands.
So I guess the question is, where is this heading now? Right? So legally, the big questions move to the BC Court of Appeal and likely on to the Supreme Court of Canada after that. Politically, municipalities will push for clear provincial playbooks, so earlier disclosure when claims intersect private parcels, standardized mapping, and templated communications to avoid the we found out after the ruling scenario that rattled all these Richmond owners, and rightfully so. Each of those lowers uncertainty premiums, which is what restores confidence first, long before the final judgment, or can at least help support it. Market timing matters too. We're in a cycle, already defined by slower sales, tightening financing, affordability issues. Layering legal ambiguity on top of this will compound caution, and I think in these specific areas, you'll probably just see people pull back entirely until some sort of path forward appears to be made. Expect buyers to overweight clean titles and over-discount ambiguous ones. Even if the underlying risk is modest, that tends to create short pockets of relative value for sophisticated purchasers who can carry longer subject periods and who can bring experienced counsel to the table. The problem here is that about 95% of land in BC is considered unceded territory. So where can a buyer or owner have confidence in their own fee simple title? Bottom line, title law is catching up to history, one case at a time. Richmond's case is also very high profile. Kamloops' claim shows the geographical scale these filings can reach, and Quebec's new action confirms that this is now a national conversation, not a one-off headline or unique to BC. I think that this will turn into years and years of litigation before an outcome is truly known. And I think one other thing, Dan, any kind of property market, any kind of market, generally speaking, if you're trying to restore confidence to a marketplace, it needs certainty, not uncertainty. And I guess the question I have here, and it really depends on what side of the argument you're on, where do we draw the line? How far back do we go? These questions, because we're dealing with a lot of people here who, were born in Canada, who were maybe born to immigrants of people who migrated to Canada, who have worked their entire life on the land that they own and had nothing really to do with the scenario, right? So again, where do we draw that line? And I guess the other question I have is, where's the government's work in this? I mean, if somebody has lived on their land for 35 years and has paid property taxes, only to have their title now taken from them, should all of those property taxes be given back? Because at the end of the day, the government didn't do anything to protect the person who has spent their entire life on that land, paying for it, upgrading it, all of that kind of stuff. So there's a lot of gray area here, and a lot of people, I think, are going to have trouble trying to decide what is fair and what isn't.
This is clearly a discussion I feel like we are going to continue to have for months and possibly years as it evolves, as it is extremely complex. Okay, let's move on now. Quick update on the arrears data, because it is freshly out. And the most recent data shows that the arrears rate did in fact increase last month by 0.01%. It now sits at 0.24%. Now, this is the highest reading in 5 years, and it brings us just under that pre-pandemic rate when it sat at 0.25%. Ontario increased by 0.01% to 0.23%. BC, status quo, it stayed at 0.21%. Both, of course, are below the national average. So how concerning is this rate? Well, let's look at it from, I guess, another perspective. 99.76% of mortgages in Canada are in good standing. 99.76%. That sounds like a pretty stable landscape when you consider that's a better success rate than most credit cards, car loans, or even cell phone payments. In other words, even with higher rates and all the economic headwinds that we're facing, Canadian homeowners are still making their mortgage payments with remarkable consistency.
Let's get back to badgering the government here, because we'll get on to GDP. Canada's economic engine hit a bit of a stall in August after posting a modest 0.3% gain in July. Real GDP slipped by 0.3%, giving back nearly all of that growth. The weakness was also broad-based. Goods-producing industries fell by about 0.5%, while services edged down by 0.1%. The biggest drags came from utilities, down over 2%, transportation and warehouse off 1.7%. Wholesale trading slided 1.2%, and mining and oil and gas extraction down nearly 1%. There are a few bright spots, though. Retail trade grew by 1%, leading all sectors. And interestingly, real estate offices saw a small but noticeable 0.3% increase in output as transaction activity picked up slightly across the country. Perhaps we have some rate cuts to thank for that. Looking ahead, early estimates suggest that GDP ticked up by 0.1% in September, which should leave Canada with roughly 0.4% annualized growth for the third quarter. Not a recession, technically, certainly sluggish performance. So what does this mean for policy and housing? Well, after 2 consecutive rate cuts, the Bank of Canada will be watching these numbers closely to gauge how the economy is adjusting. If growth continues to underperform their expectations and the labor market continues to soften, it opens the door for a final rate cut before the year end to give the economy a bit of breathing room. Though, to be honest with you, with the new budget, I think they're going to be putting a lot of that responsibility now onto fiscal policy. For the housing market, that move could mean another small dip in borrowing costs, potentially providing some relief for variable rate holders and a slight boost in sentiment heading into 2026. But make no mistake, anytime we cut rates, it's because of a fragile economy or the economy is in need. Growth is sputtering, industries tied to goods and exports are struggling, and confidence remains low. The takeaway, we're likely in for a few more months of slow growth, cautious optimism, perhaps, the holding pattern before the next big move from the Bank of Canada. And I want to add one last thing to this, and that is we need some sort of trade deal with the US, because I really think if Canada is going to get a big boost to its economy in 2026, it's going to come from that. That is a big question mark. Tariffs still hang over our economy, and they are making a a huge effect. So we need to have that dealt with sooner than later. I think if we do that, we'll start to see a much better 2026 comparatively anyways to 2025.
Okay, and here we are. It is now time for the Greater Vancouver November real estate market update. And as always, we start with the health of the market, which means sales. What were sales volumes like last month? We saw 2,257 homes trade hands, which was a notable 21% increase month over month. And it ended up actually being the second highest sales volumes month of all of 2025 after only July. Now, the thing is, though, October sales volume increases, they're actually common, where in the last 8 years in a row, October sales were higher than September. Big picture, 14% lower year over year and 14.5% below the 10-year average, meaning sales volumes are still quite slow.
When we have a look here at new listings, we hit 5,444. That is a 0.3% decrease year over year, but we're still 16.5% above the 10-year average.
So what has that done to inventory? Well, it has lowered 3 of the past 4 months, sitting at about 15,800 active listings. It dropped, like I mentioned, about 7% from the month before, though, big picture, it's up 13% from a year ago and a large and notable 36% higher than that 10-year average. So we are entering 3 slow months of sales with elevated inventory. What does that mean? Well, typically pretty straightforward. There should be more downward pressure on pricing as sellers become even more and more motivated into these slower winter months.
I think too, Dan, a lot of sellers right now, and perhaps even many buyers, they're starting to look to that spring market, especially as we get into the middle of November, late November. I think you'll start to see a big shift there. As we move into the sales to active ratio here, overall, we're sitting at 14%. It's up 3%. Looks like last month was adjusted down to 11% after it was actually registered at 12% when we first reported it. First month of buyer's market dating back to April 2020. If you can count that month, as we were actually shut down during that month. So take it for what it's worth. Before that, January 2019 was the last time we saw the region in a full-on buyer's market, almost 7 years ago. So when we break it down by asset class here, we've got 11% for detached homes. That's up actually 3%. 19% for townhomes. That's up 6%. And 16% for apartments, up 3%. So a little bit of sentiment increase there.
Let's talk about foreclosures now, because those are, again, starting to become interesting. And we saw most movement in the detached space, where though they increased by 12. There's about 223 detached homes across the marketplace now that are under or available as a foreclosure. Condos, or the attached market, it actually lowered by 7. There's 137 right now. Multifamily, 7. That's the same. And land increased by 2 up to 59. So that washes out with an increase of 7 more foreclosures, than the month before. Much slower, of course, than last month when we reported an increase of 51 unit increase. So today, if you look across all the areas that we can report on, there are 427 foreclosures available. As mentioned, the increase was predominantly in detached. Condos were down. And if you want to learn how court-ordered sales work and what kind of deals people are getting, we'll post a link to that video to check out how that all works.
Yeah, moving over here now to days on market. How many days is it taking to sell your home? After increasing for 5 months in a row, October saw a dramatic lowering in this metric, dropping from 31 days down to 22, assuming you're priced to market.
And speaking of price, what happened there? Well, as mentioned at the very top of this video, prices dropped, at least according to the HPI, for the 7th straight time in 2025. They lowered about $10,000 last month, or 0.8%, which is a notable month over month decline. Prices are down $58,000 or 5.1% since the 2025 high in March of this year. Year over year, they're down about 3.4% and currently sit at $1,132,500. This puts home prices back to basically March of 2023 prices, which means we are at a 29-month low in prices. Let's jump to the other two metrics now, including median. That actually jumped by 33,000. It sits at 970, about the third highest reading this year. And average prices increased for the second month in a row, up 12K to 1,266,000. That's the second highest average price of 2025. So Ryan, you kind of alluded to what's happening with prices going forward. We are recording this on November 7th. What is going to happen for the rest of 2025 with prices and ultimately the rest of the important metrics when it comes to housing?
That's a big question. A lot of meat on the bone there, but I'll say I think the current pattern we're in isn't going to change. There's too much elasticity in the marketplace right now. Certainly when it comes to inventory, for prices to do anything meaningful for stabilization or to go the other way. Once that elasticity is taken out of the marketplace and that slack is tightened, then you'll start to see a return to more stability in prices and perhaps more of what we're used to here in Vancouver. But I don't see that happening in 2025. You might see a decent recovery again in 2026, but it'll be slow. It's going to be a slow grind to get back to a stable marketplace. There's a lot of uncertainty here, much like we talked about, from the budget to future inflation costs to nothing really helping, the average 19 to 29-year-old who has aspirations of owning their own home. And why wouldn't they? Their parents did. But that dream slipping? And I don't know if we're going to look back on this budget as something that was a bit of a miss when it could have addressed something very serious for the future of Canadians.
That is today's episode. Thanks as always for tuning in and watching. Have a wonderful weekend, and we will see you here next week. Bye.